Dave Ramsey hates whole life insurance. Today we're going to look at some of the reasons why, but also debunk some of the blanket statements that he makes. He clearly doesn't understand whole life insurance, the benefits, the guarantees, the tax-free use of money, etc. Take a look at the video.
A quick question. First of all, I just wanted to preface it by saying, Dave, I've been listening to your show for a while, and I really want to thank you for all your advice. I used to be one of those people that really just thought about, well, yeah, I can afford that payment. I can afford that payment, and just all of a sudden, I'm just under this massive amount of debt. And after listening to you for a couple of months, I've just basically restructured the way I do everything. I'm just, stop buying stuff. I'm getting my debts paid off. Within a couple of years, I plan to be completely debt free. So, thank you very much for your advice. My question is, I've heard you talk a little bit about whole life policies. Now, my wife and I right now have whole life policies. They're good until we're 125 years old. We have about $1.5 million in coverage. Costs us about $680 a month to have that. And I've heard you sort of say that you didn't think they were a great investment, but I haven't really heard you get into any details about why you think that is. So I was wondering if you could just talk about that a little bit, and maybe I'm missing something, and if I am, I'm sure you'll hit the point.
Okay, sure. Well, the overarching main companies that sell whole life, the numbers break down about like this. Per $100 that you pay in premium, you can buy the same amount of term life insurance, 15-year level term, 20-year level term, for about $5.
Got it.
It's roughly 20x. Okay. And for the insurance, obviously whole life, though, has another component to it that term does not have. You're obviously aware of that. You spend a lot of money on this. And that other component is a cash value buildup. Now, the cash value buildup is the other $95 out of $100 approximately. Could be $91, could be whatever, but it's somewhere in that range. Nationally, across the top 10 whole life insurance companies, it is $95. Okay, so $95 going into cash value, $5 purchases the same amount of insurance, life insurance. Now, so then the gripe that those of us have that hate whole life insurance, and it's not a mild dislike, I hate it, is that what happens to that $95? And in cash value, what you will do, and you're well past this, but if you went back and looked at your policy pages, your cash value buildup for the first 3 years, your savings buildup is zero.
Not true, Dave. Let's take a look. This is a traditional whole life policy on a 35-year-old, and I'm using the same $680 per month. There are two columns of cash value we're going to look at: the guaranteed values that do not include a dividend, and the non-guaranteed values that do include the dividend. The mutual insurance companies that I use, they've all paid dividends for over 120 years. You should be looking at the non-guaranteed values that include the dividends. Notice that in the very first year, the $680 a month, which is $8,160 a year, it is true that in first year cash value, it's zero. But notice in year 3 that the cash value is $3,967. Dave is saying that in the first 3 years, there's zero cash value. That isn't true.
The second thing is that once you do start building it nationally, and again, don't know your policy, but it's not going to be substantially different. The average rate of return on the $95, if you look at your actual cash value buildup, including the 3 years of zeros on the front end, it ends up being an average of about 1.2%.
In this particular policy, the rate of return is 4.15% to 4.27%. This is traditional whole life, but it's not the 1.2% that Dave is stating. These rates of return can even be higher if we structure the policy correctly with paid up additions. But I want to point something out here. We run these numbers to someone's life expectancy. Age 80, 85, 90, somewhere in there. So you can see clearly, traditional whole life, the policies we sell, 4.15% to 4.27%. This is the internal rate of return on the cash value.
Let's be generous and say it's double that, 2.4%. Still not a good long-term investment. If I could get 2.4 on my money market, I'd be dancing a jig, but not on my long-term investments. My long-term investments need to be north of 10% to be beating inflation and taxes.
A 4.27% rate of return in a life insurance policy is tax-free. A money market account, mutual funds, ETFs, they're taxable. And I don't know where Dave is getting a 10% consistent return year in and year out. He loves to use the number, but the reality is the market is not performing year in and year out with a consistent 10% rate of return. The market has volatility. The mutual funds or stocks or ETFs that he recommends are going to go up and down in value, not consistently earn 10% every year. And those taxes will erode into profits. Depending on your tax bracket, that money will come to you taxable, and depending on your overall income, that will determine how much tax you pay on those gains and those investments that Dave is recommending.
And those two things are bad, but the stake in the heart of whole life, and the reason the entire financial planning community that are not in the whole life insurance business have abandoned whole life. No one sells this but whole life insurance agents.
Dave, why is it that banks, major corporations, and wealthy people have cash value policies? Why is that? It's not a scam. It isn't something that people should fear. These policies are an asset that add guarantees to your portfolio, liquidity, access to cash. If you're putting money in an IRA or 401k, you can't touch the money till you're 59 and a half. If you physically withdraw, you've got to pay not only the tax, but also an early withdrawal 10% penalty. It's government sponsored. And these cash value numbers you can take as tax-free money now as your own bank, but also as a stream of tax-free retirement income. Dave misses all these points. What Dave is saying about whole life usually is completely untrue.
No one sells it anymore. No traditional financial planner, no SmartVestor Pro, no one in the financial world sells it.
The reason most financial advisors aren't selling whole life insurance is because they want to manage your money and earn fees off of your money every year. So if you have a losing year in your mutual funds or brokerage account with a financial advisor, guess what? They still make money. They're still going to charge the fees. You might lose 10 or 20 or 30%. They still make money. They know that every dollar that goes into whole life insurance is a dollar that they are not earning their fees off of. That's why they're primarily not selling it.
Only people that sell it are whole life agents. They've gone away from it. And
by the way, there are financial advisors that sell whole life insurance. Dave is once again making a blanket statement, putting everyone in a box. If you're a financial advisor, you're never going to sell whole life insurance. There are plenty of financial advisors out there that sell life insurance.
And this is the reason. Once you've paid the extra $95 to build up, and on your $680 premium, you said you had a $1 million policy?
I've got $1 million. My wife has $500,000, and that's our combined premium is $680.
Okay, so $1.5 million. If you die, your wife, the beneficiary, I assume, would get $1 million. That's your face.
My daughter. It doesn't matter.
Okay.
But yes.
Yeah,
correct.
whoever the beneficiary is going to get the $1 million.
Right.
That's what they're going to get. That's all.
Well, I need to address this. And again, maybe there are some whole life companies out there that Dave is referring to where a person only gets the face amount. We're going to look at this illustration again. Now, I don't know the exact age of this caller and what company he's with. This particular policy has a death benefit of $549,000. What Dave is saying is that his beneficiary would only get the $549,000, that's all that would go to his wife. But let's look at this. Notice the increasing death benefit here in this column of death benefit. It continues to get larger. By the time this person is in their 70s, the death benefit's over $1 million. They only paid for $549,000. At the age of 80, $1.45 million, and at the age of 90, $2 million of death benefit. They only paid for $549,000. Dave doesn't understand that in a whole life policy, traditional whole life with a mutual company, there's a growing death benefit if the agent knows how to design the policy. And by the way, if a person had a 20-year term insurance policy and then that policy lapses, there's no more life insurance. Well, check this out. In 20 years, this person would have put a total of $163,000 into the policy. This is the cumulative premium. But the cash value is $221,000. That means if this person canceled the policy in year 20 with $221,000 and they only put in $163,000, they would be getting back $58,000 from the insurance company. They would have made $58,000. If you have a 20-year term insurance policy and you're still living and it expires, all that money is gone. There's nothing to show for it. Does term insurance have a lower premium amount? Yes. But the cost for term insurance is actually higher. Why? Because when that policy expires on the level term, the 21st year, the costs are even higher. Let me show you what I mean. This is $1 million death benefit on a 35-year-old. It's $909 a year. For 20 years, that premium stays level. But if they're uninsurable 20 years from now and they still need $1 million of coverage, the premium jumps to $15,000 a year. It turns into renewable term insurance, and every year the cost of that insurance gets higher. If they are insurable and they get a new policy, well, now they're 20 years older, the cost will still be higher. All things being equal, at the age of 56, 20 years later, now the premium's $5,906 a year. And when the level premium on this 20-year term policy goes up in the 21st year at the age of 77, now it's $117,000 a year in order to keep that $1 million death benefit, which most people aren't going to do unless they're uninsurable. But you can see as someone gets older with term insurance, it's much more expensive to insure their life. The reason we recommend whole life insurance is because it's a fixed cost for your entire life and you don't lose death benefit. So you can have a permanent life insurance death benefit whether you pass away at 80 or 90 or prematurely at 50. This permanent death benefit is always there, and as we just saw in the illustration prior, it's a growing death benefit. The least expensive form of insurance is whole life insurance because the costs do not go up as you get older.
If you have a cash value of $200,000 at 2.4% that you put $95 per hundred in to get to $200,000 or to get to $100,000, none of that. So you have a savings account that for the first 3 years you put in there gives you nothing.
We showed that wasn't true.
After that, it pays 2.4%, and when you die, they keep your money.
And we showed that isn't true. To reiterate, here's the cash value. It's growing over time. Matter of fact, this particular policy breaks even in about 12 and a half years. 97,000 went in, 96,000 is the cash. By the time you get to year 13, there's more cash value in this policy than what the person paid in premiums. And notice the death benefit. It's going up too. Did the life insurance company keep the $110,000? No. The cash value was a function of the growing death benefit. And we continue to see that. As I showed earlier, that death benefit continues to climb as well as the cash value.
Which makes it absolutely horrendous. So you're much better off, and many, many decades ago, the financial planning community, by and large, started moving towards buying term life insurance for the $5 per hundred and doing almost anything else with the 95, but over in the investment world away from the insurance world. You put it in a freaking fruit jar. At least it's there when you die.
Okay, so you said would your advice be to just terminate those policies and just do what you suggested, purchase relatively inexpensive term life policies, and then?
What happens when a person loses their term insurance in their later years or retirement? Right? If there's $1 million or $2 or $3 million of death benefit that immediately goes away, what does that do to a person's well-being? What does that do to a person's assets and the pressure now that would be on those assets? What does it do to their beneficiaries and the thoughts of a spouse? That's a lot of death benefit to lose. The reason whole life insurance is wonderful and not horrendous, as Dave talks about, is because it's permanent. There's a guaranteed payout, guaranteed death benefit that will go to your beneficiaries. Doesn't matter if you pass away prematurely or you live till you're 120. There's a guaranteed payout. You do not get that with term insurance. Now, I'm not saying don't ever have term insurance. Term insurance serves a purpose. But to only have term insurance, you would be leaving yourself and your family in a worse off position.
I do have investments. I mean, I could just up those investments. I invest mostly directly in the S&P 500. I've got a 401k.
Exactly.
So would you?
But get the term life in place first.
Yeah, exactly. Get your term in place first. Never cancel life insurance.
What is guaranteed in the market? What's guaranteed in the S&P 500? What's guaranteed in your 401k? Nothing. Unless you're invested in a money market account, your mutual funds, your ETFs, your stocks, none of it is guaranteed. Now, I have stocks. There's some things I like about the stock market. But to have all your money there or to be planning your future retirement because of a 401k or an IRA, it's not wise because there is no guarantee. There's a guarantee that there will be volatility, but there's not a guarantee of what you will have in the future. And that's the point Dave is missing, or one of the points Dave is missing here. There is peace of mind that comes from a guarantee. There's peace of mind of having an asset in your portfolio that you know will make money every year. You've got a growing death benefit, you have access to liquid cash, and you can use that money 100% tax-free.
I don't want you to have the proverbial milk truck or bus in the middle.
Okay.
Between the two.
So just look at the money I've been spending over the last 5-10 years. Is just write that off and just start.
It'll make you want to throw up.
Yeah.
But yes.
But that's the case. Now,
such poor advice. Dave often just gives blanket advice, right? Did he ask this person about goals? Did he ask, well, tell me about your full overall financial portfolio? What debts do you have? Do you own a home or any other real estate? Where else are you investing? No. It's a blanket statement. Get rid of your whole life insurance. That is harmful advice, Dave. The blanket statements that you make will hurt people, can hurt people. The negativity around whole life insurance is unwarranted. And it's primarily because Dave, unfortunately, doesn't fully understand whole life insurance. Maybe he had a bad whole life insurance experience when he was younger, but the blanket statements are harmful.
You will get your cash value out by canceling the policies, whatever it is.
Okay.
It doesn't die then. But you never get both.
But Dave, didn't you say the insurance company keeps your cash value and now you're saying you won't get both? Well, I just showed that the cash value is driving a growing death benefit.
I understand.
You never get the insurance and the investments, and you're always paying for both. And that's the consumer advocate like us, our reason for hating on these things and just saying they're absolutely horrible. It's an antiquated product from the 40s and 50s that built large buildings in the skylines of almost every city, and that everyone now has pretty well moved away from, except the companies with their name on that kind of stuff. So anyway, all of that to say. Now, one last part of this discussion that's worth having, because you're obviously doing well financially and you're doing really good with your analytics on this. The last thing that happens is The irony is that we really don't necessarily need life insurance for our whole life.
Right.
So if you've got $2 or $3 million in your investments and zero debt, and the kids are grown and gone, and you die, well, I think your wife will be okay.
And I addressed this earlier. When you lose death benefit in your later years or retirement, there is now added pressure to your investments. Why not pay an insurance company to take that risk for you? So let's assume this person does pass away at the age of 90. The $500,000 death benefit they purchased has now grown to $2 million. What did they pay for the $2 million? They paid $448,000. So their beneficiaries would get triple what they actually contributed to in premium. A term insurance policy isn't going to go to the age of 90. And if you lose term insurance, like Dave is saying in retirement, let your assets, let your investments, let that take care of your family. Knowing that that's all the money you have and there's no death benefit to come in and replace that money, there's a lot of added pressure to those investments to perform. And I've seen multimillionaires without life insurance that live like paupers because they don't want to spend their money because they're worried about not leaving anything behind to their family members. Whole life insurance gives you more peace of mind. And we can see here there's a growing death benefit.
I was looking at it as like, I can die broke if I want to, and at least they'll have this much. But you're right in the sense that I won't be able to spend.
Why die broke if you don't have to? I want to quickly share a properly structured whole life policy where we minimize the death benefit and maximize the cash value. We use these policies for infinite banking. This policy is the same $680 a month on a 35-year-old. You'll notice here's the annual $8,160. Look at this first year cash value, $6,232, not zero that Dave talked about. Year 2, $13,000, not zero that Dave talked about. And year 3, over $20,000 in cash value, not the zero that Dave talked about. The death benefit is still growing. We see that over here in the far right-hand column. Cash value continues to grow. Matter of fact, this policy breaks even in year 6, $48,000 in cash, $48,000 in premium. These policies are designed to be used as infinite banking to take policy loans to invest in real estate, buy crypto, invest in a business, buy a car. It really is your own bank. Most everything that Dave Ramsey says about whole life insurance is completely false. He uses blanket statements that can be harmful to people taking that advice. What's interesting is that whole life insurance aligns with Dave Ramsey's own financial principles. Think about it. Dave recommends term insurance, and in the illustration that I just showed you designed for high cash value growth, that's a minimum whole life insurance death benefit with a term insurance rider added to increase the cash value access and growth. Dave emphasizes avoiding debt and being your own bank. That's exactly what high cash value whole life is about. He stresses having strong emergency funds. He advocates for predictable, steady wealth building, which you get in a guaranteed whole life policy. He's passionate about leaving a legacy, which we just said, term insurance is going to go away. Whole life insurance is a legacy. It's a guaranteed payout to beneficiaries. And he warns against market risk and get-rich-quick schemes. The stock market, we all know it's volatile. There are no guarantees. So these financial principles that Dave recommends are found, interestingly, in whole life insurance. We invite you to look at your own numbers, see how a high cash value properly structured policy will work for you.